Okay, let's dive right in. Today, in this explainer, we are tackling the massive macroeconomic forces that literally govern a nation's wealth. We're going to take what might look like some pretty dense national accounting and transform it into a high-stakes story of global survival. We'll be looking at how countries interact with the rest of the world, how they track absolutely every single penny that crosses their borders, and, most importantly, what happens when that money simply runs out.
Here is our quick roadmap for today. 1. Inside the open economy. 2. The balance of payments. 3. Unpacking the current account. 4. Unpacking the capital account. 5. BoP equilibrium and disequilibrium. And finally, 6. The 1991 economic crisis.
All right, Section 1, Inside the Open Economy. Let's go ahead and lay our foundation.
So think about it. A modern economy doesn't just exist in a vacuum. It is constantly interacting with the rest of the world. In our current era of globalization, an open economy is defined by these incredibly dynamic, non-stop interactions, primarily through various channels of trade and capital flows. To really wrap our heads around an open economy, it kind of helps to compare it to its total opposite, a closed economy. A purely closed economy is 100% self-sufficient. Zero imports, zero exports. Now, practically speaking, there are pretty much no perfectly closed economies existing out there today. Sure, some countries use protectionist policies to restrict trade, which makes them a bit more closed than others, but for the most part, we live in a world of open, actively trading nations.
So how exactly do they connect?
Well, it basically boils down to three main pillars. First up, you have the output market, which is just trading physical goods and services. Then the financial market, where a country can buy and sell international financial assets. And third, the labor market. This is where firms actually choose where to set up their production, and workers decide where they want to sell their labor. These three channels are the whole shebang. They allow citizens to buy global products and export their own domestic creations.
Now, I want you to imagine the entire national economy is just one giant checkbook. Foreign trade has a massive, direct impact on a country's aggregate demand. When we buy foreign goods, like say those imported smartphones we literally all have in our pockets, that spending escapes as a leakage from our domestic circular flow of income. And that obviously decreases domestic aggregate demand. But on the flip side, when a country exports goods, or maybe software services, that money acts as a huge injection right back into the system, driving up demand for domestically produced stuff.
Moving right along to Section 2, the balance of payments. With millions of these injections and leakages happening every single day, how on earth do we keep track of it all?
Enter the ultimate accounting ledger, the balance of payments, or BoP. This thing records every single transaction in goods, services, and assets between a country's residents and the entire rest of the world, usually measured over the course of a year. And this massive ledger essentially splits right into two main branches, the current account on the left and the capital account on the right.
Let's dive into Section 3, Unpacking the Current Account. We're going to zoom in on the day-to-day trade on the left side of that ledger.
So, the current account strictly records ongoing daily trade. It breaks down into three things: trade in goods, trade in services, and transfer payments. It is basically the real-time heartbeat of exactly what a country is producing and consuming.
We can break the current account down even further into visibles and invisibles. Visibles are exactly what they sound like. Physical goods you can literally see crossing a border in a shipping container. The difference between the export and import of these goods gives us our balance of trade. Invisibles, on the other hand, are things like services, transfer payments, and income flows. Now, physical goods might get all the attention, but these invisible transfers, like, a relative sending money home from abroad, or a major tech hub exporting software services, they play an absolutely massive role in the national income.
Ultimately, you tally all these visible and invisible transactions up, and depending on the ratio of receipts to payments, a country is going to find itself in one of three boats. If receipts are higher than payments, boom, you have a surplus. The nation is actually a lender to the rest of the world. If they match perfectly, it's balanced. But if receipts fall short of payments, the country's sitting in a deficit, and it literally has to act as a borrower just to cover that gap.
All right, Section 4, Unpacking the capital account. Time to look at the assets and debts on the complete opposite side of the ledger.
I like the current account, which is all about the daily flow of goods and services. The capital account strictly tracks changes in the ownership of national assets. We're talking big-ticket items here. Massive international investments like foreign direct investment, huge sovereign loans, external commercial borrowing, and institutional banking capital. Okay, this part trips a lot of people up because the accounting here can feel totally counterintuitive. If a company inside your country buys a massive asset abroad, let's say an Indian company buys a famous UK car manufacturer, that is actually registered as a debit on the capital account. Why? Because the precious foreign exchange needed to buy that company is physically flowing out of India. That's a capital outflow. On the flip side, if you sell an asset, that brings foreign currency in, creating a credit or an inflow.
Section 5. BoP, equilibrium and disequilibrium. So what actually happens when these two massive accounts don't balance out perfectly? Ideally, the demand and supply of foreign currency equalize, and you get a nice, stable equilibrium. But what happens when that national checkbook just flat out breaks down? You know, an imbalance might sound like a super dry accounting problem hidden on a spreadsheet somewhere. But as we're about to see, it triggers some massive, real-world panic. We call this imbalance a BoP disequilibrium, when the balance of payments is in a severe deficit, meaning way more foreign currency is bleeding out of the country than coming in. The Central Monetary Authority, like the Reserve Bank of India or RBI, is forced to step up. They have to act as the ultimate financer. To cover the gap, the RBI has to perform an official reserve sale. They literally have to start selling off their own hard-earned stash of foreign exchange just to keep things afloat.
Economists, of course, have specific labels for all this. Normal, everyday international business transactions, those are called autonomous. But when the central bank has to hit the panic button and manually step in to cover a deficit, those are called accommodating transactions. You'll often hear them referred to as below-the-line items. And hey, because tracking millions of global trades across borders is never completely perfect, there is always a final line item called errors and omissions, just to catch the inevitable compilation gaps.
Finally, Section 6, the 1991 economic crisis. Let's take a look at what a severe disequilibrium actually looks like in the real world.
The 1991 economic crisis in India was an absolute nightmare scenario, a cascading sequence of global shocks. First, in 1990, the Gulf War kicks off, drastically inflating the price of oil. That is a massive import and a massive leakage for India's economy. Then, early 1991, the USSR suddenly disintegrates. That severely reduces demand for Indian exports, cutting off vital injections of cash. By mid-1991, to cover this completely unmanageable widening deficit, the RBI had to sell off its foreign exchange reserves until they were virtually completely gone. Naturally, the value of the rupee completely plummeted.
The situation reached an absolute breaking point. Because the RBI literally did not have enough foreign exchange reserves left to cover the deficit, the nation had to take a truly drastic measure. Think about this. India was forced to physically pledge 65 tons of sovereign gold just to secure emergency foreign loans. That was literally the only way to make the BoP hit zero and stave off a total catastrophic default. But here is the wild part. This terrifying crisis actually forced a fundamental transformation. India liberalized its economy shortly after, and it proved the sheer power of economic reform. By opening up, the RBI was able to rebuild its reserves from virtually zero in 1991 to a staggering $634.287 billion by early 2022. Talk about a comeback.
However, the global market never actually sleeps. By September 2022, those reserves have dropped back down to roughly $545.65 billion, thanks to totally new global pressures. It's a pretty stark reminder that the balance of payments is literally never settled. It leaves us with a huge question for the future. When the next inevitable global shock hits, will automatic market forces of supply and demand be enough to fix the balance, or are we going to see central banks forced into drastic, deliberative interventions all over again? Definitely something to keep in mind the next time you see a headline about trade deficits.